Hi everyone, Tony Cottis here from Great Vocal Majority. Today I'm here to talk about the April jobs report from the Bureau of Labor Statistics. In this video, I will explain what the job results are, what they're telling us about the state of the U.S. economy, and finally, what it's telling us about where the economy is going. I will also try to show you how some of the aspects of the Bureau of Labor Statistics report relates to other parts of the economy. I think you'll find it interesting and I hope understandable to the average person. So with that in mind, let's get going. The U.S. economy and jobs market is vast and complex. Most reports from the BLS have a blend of good and bad news. This report's no different, but the bad news outweighs the good news, as you will soon see. First, let's look at the positives. The unemployment rate remained steady at 5%. Hours and wages increased. The absolute number of people unemployed decreased, as did the number of people who were unemployed more than 27 weeks, which is often referred to as the long-term unemployed. More on that a bit later. And the total workforce grew by just over 200,000 people. You may be wondering why I think the unemployment rate remaining unchanged is being labeled as a positive. In the context of all the negative results, holding that 5% rate is a good thing. The increase in hours and wages is ahead of the rate of inflation, but it's also ahead of the rate of economic growth, and I will also address the meaning of that. The decline in long-term unemployment is also a mixed blessing. Yes, it's good that 150,000 fewer people are out of work 27 weeks or more. But did they find work or did they just give up looking for it? More on this later. Now, on the negative side, the absolute number of people actually employed fell by 316,000. Now, more full-time jobs were created as part-time jobs decreased, but 78,000 more people were forced to work part-time due to economic reasons. Nearly 600,000 people, 562,000 people left the workforce in the month of April. Now, considering that only 160,000 jobs were created, which was the lowest result in 7 months, and 150,000 are no longer counted in the long-term unemployed, it's a safe bet that many or most of those long-term unemployed folks just left the workforce. Now, after rebounding for a few months, the workforce participation rate declined by 0.2 of a percentage point. There are a few metrics I did not show here that are worth mentioning. The latest data on corporate profits is published by the Bureau of Economic Analysis, and that showed a decline for fourth quarter 2015. Keep that in mind in the context of all of these statistics. In other words, corporations are making less money. Now, add to that GDP for the first quarter in 2016 is near recessionary levels. It's only 0.5% growth. And most importantly, productivity for the first quarter is a negative 1%. Now, one of the other negatives that I didn't mention, it's a minor one though, is that the prior month's job numbers were also adjusted downward by 19,000. Let's talk a little bit about productivity. Productivity is a measure of the return on investment in inputs for a business. The higher the productivity, the better. For the business manager, productivity tells them whether expansion is warranted or affordable. For example, if productivity is high, the business manager knows that adding more inputs, like, for example, employees, will get him or her more profit bang for the buck. Low productivity is a warning that the assets of the firm are not performing. They're not producing, hence the term productivity. They're driving less income relative to their input cost. Therefore, The growth in productivity is arguably the most important measurement. This chart compares the quarterly productivity results for each presidential administration going all the way back to Richard Nixon in the 60s, late 60s. The current administration's performance is so abysmal, it's only exceeded in its futility by the performance of Jimmy Carter. This chart illustrates quite dramatically how the economy has slowed down over the past year. GDP growth is only 0.5%. That's that very small bar to the far right. This kind of decline underscores the parallel decline that we see in productivity and in corporate profits. Now, each month, GreatVocalMajority.com publishes a cheat sheet chart, say that 3 times fast, summarizing dozens of statistics in the Bureau of Labor Statistics report just on one sheet. This is only part of that sheet. The left side of this chart shows the actual job numbers for the last 3 months, along with any revisions, and the job breakdown created in the current month by the major industry sector. The right side of the chart has the U3 unemployment rate over the last 3 months and any changes to that, in addition to all the demographic breakdowns. Demographics in terms of men and women, age, education, and race. Now, generally, this cheat sheet and analysis is published the same day as the BLS issues its report. And I try to get it out within an hour of the release of the report, but I don't always make that. Now, in this chart, this is an important chart. I've plotted the people who are retiring versus the people who are discouraged from looking for a job. What we're trying to look at here is the composition of the people who leave the workforce. Now, people who leave the workforce either leave it because they're retiring or because they're discouraged from looking for work. Now, a smaller number may be disabled, so that is not included in here. It's probably, to be honest, it's probably coming out of the retiree number, because a retiree person is someone who goes from being employed at the beginning of the month to being out of the workforce at the end of the month. And that typically would be how a disabled person would end up out of the workforce. So if any of these numbers are inflated, it would be this retirees number, the red jagged line on the top. I'm looking for how to break down discouraged workers and what's happening. Okay, so anyone who began the month unemployed and ended it out of the workforce are classified as discouraged worker, because an unemployed person could only leave the workforce if they were discouraged. Let's first examine this red line for retirees, though. During the late 1990s, the first wave of baby boomers began to retire. Monthly number increased to about 3.5 to 4 million per month. Then, beginning in 2010, there began a very gentle sloping upward of that of the number of people retiring. But if you note, the increase has been gradual, and even after many years, and still remains within a range. Let me give you an example of what I mean. If you look here, here's where I said it's beginning to slope upward. But look at the range. This is a 20-year period, and it's still within this range. It's only just now. This chart, by the way, only goes through the month of September, but I still think you get a general idea of what it's doing, what the trend is. You can see that it's just now beginning to break through the historical range. So those are retirees. Now, if you look at the blue line for discouraged workers, the first thing you'll notice is how this is marked by much less month-to-month variability than the red line. And over time, it's been very stable. Look at the range it's been in. It's been in a range of 1.5 million to 2 million each month. Okay, so you could see, and then right here, look at this burst. There's just this tremendous burst, and that is the 2008-2009 recession. Now that bubble, this bubble here has lasted until now, because this line here, this dotted line, what this represents is the historical high in this 20-year average. That's why This piece here comes right up to that dotted line. So that indicates that we're just coming back down now to the historical high of people leaving the workforce. So what this really tells us is that there was a structural change in the labor force during the recession. And now I'm going to try to quantify that structural change. And we're going to start by looking at the workforce participation rate. The workforce participation rate has been the subject of much discussion in recent months. Essentially, the BLS defines the workforce as anyone actually working or looking for work. When Barack Obama took office in 2009, the workforce participation rate was 65.8%. And today, it stands at 62.8%. Now, while some of that decline was to be expected, the steepness and suddenness of the decline under Obama points to other factors. In other words, we wouldn't have expected this decline to be 3 points, maybe 2 points, but not 3 points. What I don't have shown here is if you look at the workforce participation rate over a 20-year period, what you'll see is the workforce participation rate hovered in a range of about 1.5 points from low to high. And it was only during the 2008 and 2009 recession that it collapsed below, right through the bottom of that range. Now, that would suggest that retirements can't fully explain the decline. On the other hand, there are some analysts who have observed the surge in non-retirees leaving the workforce and want to test the validity of the U3 unemployment rate. Because think about it, if there was a structural change in the labor force, then maybe the U3 unemployment rate isn't the right rate to use anymore, because it doesn't truly reflect the number of people who are unemployed and really would like to work if they could find work. Because now we have more people than ever who are discouraged from looking for work and they drop out of the workforce. And because there are safety net programs out there to take care of them if they drop out of the workforce, not like unemployment, but like welfare, and then you have the possibility of why there's so many people continuing to be out of the workforce. They estimate, these other analysts, that there are between 5 and 7.5 million people who are not eligible to retire, but who left the workforce unable to find work. Now let's take a look at the exercise I've done here. As a starting point, we're looking at the February 2009 workforce participation rate. In February of 2009, the first full month of Obama's presidency, was 65.8%. Next, let's look at the current workforce participation rate of 62.8% and ask the question, what would the U3 unemployment rate be if the workforce participation rate today was the same as it was in 2009? To do this, you need two current numbers from the BLS, the total number of people employed and the total number of people in the adult population. And there we have it. Now, once calculated, the revised number of unemployed and the revised number of those not in the workforce can be calculated along with the revised U3 rate. Here's what I mean. The number of people employed is 151,004. Total number of people in the adult population is 252,969,000. This is what was reported in April in the BLS report. The workforce, since we're using the number that was in 2009, we're going to take the 252 million number of people in the adult population and apply that 65.8% workforce participation rate number, and that'll give us the total number of people in the workforce. From there, it's easy to calculate the unemployed because it's just subtraction. The difference between the number of people employed and the number of people in the workforce are the unemployed. And once we have that, then we can tell who is not in the workforce, because that is also just a subtraction of this number from this number. So what we see here is that if we had the same participation rate we'd have about 7.5 million more people unemployed than we do now. This is the number that is official now. This is the number if the participation rate remained the same. And everybody knows about the 94 million people that are out of the workforce. That number should really be, if all these people were discouraged workers, that's a very big caveat, would be 86.5 million. And that would mean that the recalculated unemployment rate would be over 10%, not 5% that we're getting now, but 10%. So when you see in the political campaigns, people like Trump and Bernie Sanders out there saying that the unemployment rate is much higher, it's at least 10%, this is what they're talking about. But that 10%, to be fair, is a little high because you have to assume that there were some people retiring at a faster clip than in previous years. But even so, it still means that there's at least 5 to 7.5 million people sitting in this number, not in the workforce, that should be in the workforce. I want to also point out some other signs that are not in the news. Remember what I just said. There are at least 5 million people, maybe as many as 7.5 million people out of the workforce that would like a job if they could find a job. This is a report called the JOLTS survey, also published by the Bureau of Labor Statistics. This shows that there are about 5.5 million job openings in the United States right now. So what does that tell you? That tells you that either the jobs are part-time, they don't pay enough, or they require a skill that the workforce doesn't possess, the people out of work, that they don't possess. And that may point to a retraining possibility. People may need to be retrained into new jobs, into new careers. What we don't know from the JOLTS report and this JOLTS survey is the kind of jobs we're talking about. But I think it's fair to assume that when you have 5.5 million job openings that are unfilled and you have so many people looking for work, that you can assume that these jobs are just not good fits. They're probably, many of them probably part-time work that isn't sufficient for a person to live on. There could be minimum wage jobs in there. There could be part-time work in there. Could be part-time work at a good level of pay. The point is that these jobs would be getting filled. But the problem with the economy is shown by what I have circled here. You see, the rate of job openings had been growing at the fastest pace since the BLS began keeping these records in 2000. But in recent months, you could see this is leveling off. I mean, here we are, we were on a slope upwards, pretty good angle on that. So that's a good rate of increase. But now, over the past 5 months or so, flat. Think back to the GDP chart I showed you, where the GDP is shown declining. This is an indication that GDP is declining and corporate profits are declining because companies aren't going to hire if they don't have employees that are producing, and they're not in an environment where consumers are consuming and they can't grow, they can't expand. That's a problem. So the economy is being hurt because of growth. The problem in the economy is not, the unemployment problem is tied to growth. So what did we learn today? We learned that the details of the April BLS employment report, some of the key features of that report. We learned the current state of the U.S. jobs market and how there are so many people that are out of the workforce and that the unemployment rate isn't really true. And we know that the BLS report also tells us things about the economy, like those 150,000 people who are long-term unemployed that just dropped out of sight. They didn't get jobs. That tells us something else about the economy, that it's still very hard to find a good job. And we also learned that there are at least 5 million people not looking for a job, but they need a job. And there are also 5 million jobs that are unfilled and available. But on that one, we just don't know what kind of jobs they are. And we also know that the number of people out of the workforce, as I mentioned, is not driven by retirees, but by discouraged workers. And finally, that you can find cool information like this at greatvocalmajority.com and impress all your friends. That's it for me. I'm Tony Cottaspati. Thanks for watching this, and I hope got something out of it. Thanks again for paying attention.